Welcome to this edition of IG Live. It's Charting the Markets on this Thursday, the 4th of August. As we await the Bank of England's interest rate meeting in just a short while, we're going to give that a bit of a wide berth because as we are widely expecting 50 basis points in the bag, it's pretty much all really now about just what the Bank of England says about the outlook. So we're going to put that to one side, but we're going to focus more on some of the other interesting moves in the market. In the next 15 minutes, we'll be talking to a guest. I'll introduce you in just a moment, but I want to be talking about what's happening with some of the recovery trades we've got on indices at the moment. We've got to see new higher highs, especially on the Nasdaq. So we'll take a look at that and ask the question whether this is now part of what could well be a long sustained rally, or is it something else? That's the question I'll be putting to our guests in just a few moments' time. Outside of that, the early morning call this morning, I was talking about this drop in the price of oil. Fundamentally, there's some reasons to be selling. This is a little bit more oil coming onto the market. It's only a small amount, but OPEC and OPEC Plus members have agreed to release more oil. And we've seen these recent prints from some of the inventory data showing that there is this build-up and we get a bit more oil on the market. So there's possibly a good reason to sell this. But again, the same sort of question, is this just a shorting opportunity before we return to higher highs? We'll get that as well in the mix. Also, we'll be taking a look at what's happening with lumber and how this links into other aspects of the market. We've been covering lumber quite a lot here at IG, and clients are quite interested in what's happening. And we saw a new lower low today. We broke some interesting support, which we'll catch up with in just a few moments' time. And let's introduce our guest now for this Thursday morning. It's Serge Berger from thesteadytrader.com. Serge, welcome. Thanks for joining us. I know you're in New York this morning, so it's a very early part of the day for you. But I wanted to pick up, if I can, first of all, on what's happening with these indices, and most specifically the tech-heavy Nasdaq, as we see this rally get underway. And as we were reporting this morning, we have this new higher high. It broke some resistance. It's fairly minor resistance. It's broken, but nonetheless, as these candles climb, we do have to ask ourselves just what's happening. Is this something of a more serious move up, or do you think something else is afoot?
Hi, Jeremy. So I didn't quite catch your question. Was this going to be on oil or on equities just now?
I beg your pardon. I beg your pardon. I was going to talk about the Nasdaq first of all. This market move that we've got underway at the moment. And as I was saying, we're just witnessing these relatively strong candles on the upside, and this trend that now seems to be in place, which has taken us above some recent minor resistance. And I was asking you whether or not you feel that there's any more upside to go, or is this something else that's playing out here?
Sure. No, that's perfect. So look, the way I see it is the economy, both when it accelerates and when it decelerates like it is right now, that doesn't happen in a straight line. So when you get to a point in the economic cycle where the central banks start to sound a little bit less hawkish, which is basically what the Fed did a couple of weeks ago or a week ago, that's when you get to a point where it's pretty easy for the things that are interest rate sensitive, like some of the high flying tech names, particularly if they're not profitable, they tend to get a bid pretty quickly, particularly here in the summer. So I think we remain in a bear market. I brought a chart along of the Nasdaq 100, the NDX as it's called, and you can see we very much remain within the confines of that long-term bullish trend, but certainly well off those highs. I do expect us to have another leg lower. I'm not quite sure if we reach the June lows anytime soon. Maybe that's more of a fourth quarter story. I don't know exactly the timing. What I do think is that we're getting very, very overbought in the near term. So it's very possible that we're slipping into a range, a trading range, over the next, really maybe starting, could be as early as today or later on, or maybe tomorrow or next week, where we've reached the upper end of the trading range. We have a low end of the trading range, the June lows, and something like Apple actually gives us a really good idea of what that trading range could look like.
Well, that's a good point. Let's pick up on the Apple trade, because it's one of those stocks that seems to be have crept up on the outside lane, and we haven't really, well, I for one haven't really noticed just how strong Apple has been from those recent lows. Again, that's the same sort of question, I guess, as we've got for the Nasdaq. More higher highs for Apple as we go towards that $3 trillion market cap level?
I don't think we're going to see higher highs in Apple. I think we're going to be probably quite capped at the highs that we saw basically in earlier this year, and then again in March of this year. But I think the June lows are a good reference point as well. So we're looking at Apple somewhere around 130 on the downside, maybe high 120s. On the upper end, you have something like 180. So I'm not quite sure even what 80 is reasonable. I think more or less where we are here right now in the high 160s, maybe we see low 170s, always possible. But I think that trading range from here gets really difficult to expand much higher. So I personally am much more of a seller of Apple here, or doing anything bearish like buying puts or various option structures here, than trying to chase Apple a lot higher. I think we're in a classic bear market rally, as I said before, and it's easy for algorithms to push the market around in this, quite sleepy and low volume summer tape.
Okay, let's steer away from equities and indices and pick up on a couple of the commodity markets generally. I want to begin with oil, if I can, and talk about these recent declines we've had. I don't know which chart you want to bring up, but I know Brent is interesting because it's below the $100 a barrel level and below the 200-day level. And WTI similarly has punched below 200-day SMA, and it's looking fairly strong on the downside. And I don't know, I was talking at the top about some of the fundamental reasons as to why we should be selling this down with more oil coming onto the market and inventories picking up again. How do you feel technically about the oil charts?
Yeah, so I brought up the Brent chart, and I'm going to make this a bit larger. But basically, what you can see is exactly as you were referencing to. We're essentially making lower highs, and I think that does play into the not deflationary but disinflationary environment that we're moving slowly into. The economy is slowing down hard. Inflation is, in a rate of change terms, is going to start coming down, not in absolute terms necessarily, but in rate of terms. So the rate of change of inflation is going to decelerate, so disinflation. And purely technically, I would expect that the Brent oil probably has a next stop somewhere around 90. The timing around that's always difficult because you have both supply and demand headlines all the time in oil, as it relates to OPEC, for example, which is always tricky. But I do think the path of least resistance here is lower through a multi-month lens. Maybe that leads us into October, but I do think 90 or thereabouts is quite likely if we continue to see the economies slow down as sharply as they have.
Talking about the economic performance, let's bring in a chart on lumber. Lumber is one of these areas that it is a bit niche, let's face it, not often looked at. But I think there is some interesting moves there, and related specifically as well to what's happening maybe in the wider economy.
Very interesting. So there's lots of statistics and analysis around lumber, and what it does is it gives us a pretty good idea where we are in terms of economic growth in the bigger sense. Now, it's not a perfect indicator. There's plenty of times when it's completely wrong. But if you look at this chart of the random length lumber price, and this is a multi-year chart, you can essentially, if you were to overlay this with like the ISM manufacturing index, which is a manufacturing data, you would see that the ISM manufacturing for the United States, for example, actually topped out in the spring of 2021. That's also in this chart topped out. We could overlay this on other data points, like, for example, the five-year forward to the break-even inflation rate. That one too made actually that one topped out earlier this year, so which is when we had a lower high in lumber. So it's a good economic barometer. And if we talk about disinflation, as we mentioned on the previous chart on oil, here too you can see that sort of this lack of demand, at least from a charting perspective, for lumber does speak to that disinflation. Of course, commodities have had a difficult few months, anything from copper to, in this case, lumber, pointing out that the economies are slowing and the disinflationary environment is likely going to start kicking in here, or actually already has kicked in over the past few months.
So do you see us breaking that next line of support that you've got? I think there's a low, I think, that occurred back in August last year. Do you see that as a fair price target to be broken, or is that likely to be support? Because if you look back as well into the middle of the chart that you got there, you got that line of support being, I think you hit twice there, aren't you? Exactly there, yeah. So is that a good line of support to watch out for, or do you see that broken?
Yeah, I think it's a natural attraction point. It's a bit of a magnet. I will say that we're starting to get quite oversold, and lumber, just like anything, can be rather volatile. We've had a pretty decent sell-off here for the past few weeks, and of course, yesterday was ugly. So, whether we get to, it's about, on this particular chart, the numbers are about 450 or so. Whether we get there or not is kind of a rounding error. It's like anything. Like the longer you go into a bear market, the more difficult it gets to short. So shorting it here is not as good a trade as it was, a couple of weeks ago, for example. So yes, I think we can get there, but just keep in mind that we are quite oversold already. So a strong counter trend bounce is becomes more increasingly likely as the lower we go. But yes, I mean, from a simple charting perspective, those recent lows would be a natural attraction point for a small trade.
Yeah. As is always the case, I do want to catch up with you if I can on currency markets. And I know we're going to be talking about the dollar yen. The dollar yen's an interesting chart. We've seen this massive rise for the dollar against that weaker Japanese yen. And more recently, we've seen a reversal of that. But we've seen some interesting support at 131.49, I think it is. There was a candle print intraday below that just a few days ago, but we've seen this line held up as support. It had previously been resistance. How important is where we are? And do you see that high of 139.40, I think it was, back in the 14th of June, broken as we see more money going back into the dollar as we see things the last few days?
Yeah, I think the dollar is going to remain quite strong for the time being. I think it depends a little bit on what happens when the Fed starts its quantitative tightening a bit more forcefully in a few weeks from now. I think it's about 4 or 5 weeks from now, something like that. So that will be pretty telling for currencies, for the dollar as an index. Dollar yen has a whole nother set of issues to deal with, and a lot of those issues are really focused around basically the dynamics of the central bank trying to defend its currency without hiking rates. So it's very possible that we start moving into an environment where the more the global economy slow down, the less the yen will be able to keep that weakness and start rallying, which in other words, of course, would be a move to the downside here. So I would be cautious in trying to be too bearish dollar yen here. I'm really looking at this through a multi-month lens, and I still think ultimately dollar yen has quite a bit lower to go. Maybe it's the mid 120s, or sorry, the low 120s over the course of a 3 to 6 month period. It just depends on how quickly the global economies start to slow, where also the Japanese economy slows, and then that'll kind of force the central bank there to give up its sort of grip on the currency.
Yeah, and of course, when talking about the dollar, we've got to look at the gold price as well. Not necessarily against dollar yen, but the dollar generally. When the dollar strengthens, as we've seen, it puts gold under pressure. But we've seen this little mini rally in gold at the moment. Do you like that association with the sort of the converse trade you get between gold and the dollar, or do you think the gold's got a life of its own?
I think we've had such a dramatic risk off period, January through June, the last 30% or 20% on depending what you're looking at, notwithstanding on the risk assets. But I think what happens when you have a big de-risking in the market, remember, fixed income had an awful first half of the year, and equities did too. And what happens then is people tend to sell what they can. Gold being one of those things in portfolios. And I think the less of that forced selling we see, the more gold will be able to start doing what it needs to do, which is shine, no pun intended, in the kind of environment that we're in. I think gold is probably going to look better if we look at the next 3 to 6 months. It's going to start looking incrementally and absolutely and relatively better versus things. The less portfolio managers are forced to use gold as a source of funds to take down risk in their portfolios.
Okay, so you're waiting for the next, the back end of the year, you're thinking for the next leg up for gold?
I think that gold is probably bottomed for the year. And I would expect over the next 3 to 6 months that gold starts creeping towards the upper end of that range. So we're looking at around 2,100, 2,100. And ultimately, you know, who knows if it's going to break out of this range, but I think that's a big move back up to 2,100. But I think it's reasonable through the rest of the year into maybe Q1, maybe Q2 next year. I think gold is really difficult to time in the immediate perspective, in the immediate time frames. But if we understand that gold is used as a source of funds in bear markets, and if panic is going to start decelerating from here, the later we get into the bear market, the more gold has a chance to start doing well here over the next 3 to 6 months plus.
Okay, Serge, thanks so much indeed. We'll leave it there, but thanks for joining us for this edition of Charting the Markets. That's Serge Berger from thesteadytrader.com. If you want to catch up with Serge, he does, I know, respond through his website, but also through Twitter as well. If you want to watch this again, you can do so on IG.com. My thanks to our guest in this last 15 minutes. For more videos from us here at IGTV, join us on Twitter at IG.com, Instagram, and subscribe to our YouTube channel.